now. Okay, everybody, welcome. It's 4:20, not 4:22. Sorry about that. We're working on Chapter 9. Chapter 9 has quite a bit of reading for the first 3 learning objectives. There are a few questions coming out of learning objective 3 that are quantitative, should be a review for you from what we've done previously. What you should focus on is the classifications in those first 3. So you got to make sure the reading's important. Remember, we have a reading quiz that is due today by midnight. You'll have about, I think it's 16 minutes to take it. And there's 11 questions. So you want to make sure once you start it, you've got a 16-minute block to finish it, but you can take it anytime between now and 11:59, but you'll want to make sure you start to give yourself the full 16 minutes because it closes and locks out. And that's in Pearson. We also have the classwork that'll be due at the end of the week. And it kind of mirrors quite a bit what we're going to be doing here. So most of this material is a review on cash flows because we've had to do a lot of it as part of our assets, current assets, and liabilities section. And long-term assets as part of the investing section. So given that this is a review, I'm going to try to assess sort of what you remember about the statement of cash flows. And so I'm going to ask you to sort of type in the chat, what do you remember or what do you know about the statement of cash flows? And so that'll help me kind of get a basis for how I'm going to go about this. But everybody should respond in the chat with some facts that what they know about the statement of cash flows. Good. Thank you, Madison. Good. Thank you, Emma. Thank you, Rebecca. Good, Olga. All right, give you another minute here. This is kind of our way of participating. I know what you're getting at, know where you're at. Okay. All right, gonna kind of step forward. So a little bit about the statement of cash flows, and it's one of the important accounting statements along with the balance sheet, the income statement, and the statement of changes in shareholders or stockholders equity. And it shows the cash inflows and outflows, and they're divided up by activity. And the activities are operating, investing, and financing. And Operating is the ongoing activities of the company. So you'll get the cash inflows and outflows related to current assets and current activities. Investing is the purchase of sales of non-current assets, those long-term assets, property, plant, and equipment. Also cash acquisitions and financing investing activities or financial investing activities. And now you got to keep those financial investing activities sort of separate from financing, which is activities with ownership. So dividends, common stock repurchases, common stock issues, and treasury stock as well. And then you have debt holders, but it's just related to the principal. It excludes interest expense, which is an operating activity. So it is separate from the balance sheet. It's separate from the income statement. Any questions after you take a look at that? Okay. So just want to make a note here too, non-cash activities such as purchasing or an acquisition with stock or a large asset purchase with another asset instead of cash or bonds / notes for property, plant, and is reported in the notes. So as not to be confused with cash activities. Little typo up here I'm fixing. All right, so that's the basics about the statement. I think for the most part, you guys knew about the operating, investing, and financing activities. So you'll be familiar with that. And I'm just going to kind of talk about here a couple different things that you're going to see in this text and just in general. So typically the way the cash flow statement is you have cash, changing cash from operating activities plus the change in cash from investing activities plus the change in cash from financing activities equals the change in the net change in cash. You add that to the beginning balance in cash, and that equals the ending balance in cash. Okay. All right, so point from your text. So in the text, sometimes they'll have a question where it says, what would it take from financing to cover operating and investing cash flows? And what they mean is what amount would make cash flows neutral or net change in cash equal to zero. Typically, they'll do that with first-year companies. It kind of threw me off when I was looking through the questions, so I figured that I would head it off for you if you had any, so you didn't have the same questions that I had. And remember, change in cash flows can be negative, and the net change in cash flows can also be negative. As long as the company has access to a credit line or cash reserves. Okay, so somebody asked, is paying dividends operating or financing? And so dividends is a transaction with shareholders. So dividends goes under financing. And when you think about it, it's kind of in that retained earnings column, but it's not part of net income. So it gets excluded from there. All right. You have two methods to do the cash flow statement. So make sure in your reading you understand the difference between indirect method and direct method of operating sections for the cash flow statement. Okay. Any other questions before we jump in? Sorry, I slid it down a little far. Okay. All right, so let's take a look at kind of a question that takes the indirect approach. And what they're asking is how much cash is collected from the cashews company from customers. And so cash collected in general is cash sales and amounts collected from accounts receivable. So one thing I want you to be careful about is I want you to make sure that when you're looking at these questions that you look at the years. So this is 2011, this is 2010. On some of the questions, they'll reverse that and they'll have the oldest year first and the newest year second. It'll be almost the exact same question. So instead of having cashew, it'll have butternut as the company, and they'll just swap it and say, okay, what's our new case? So you have to read these questions carefully. So our sales collected, or our sales equals 90,000. And they don't tell us whether or not it's cash or on account, but we don't really need to know. That's our starting point for collections. We have to then look at what's happened to our accounts receivable balance. And so our accounts receivable balance was 10,000 at the beginning of the year, but is 8,000 at the end of the year. So customers paid $2,000 more than was sold on credit. So we take the 90,000 sales, add the 2,000 change in cash collections, and it equals 92,000. And so our answer for the first one is D. Okay. All right. Now we have to follow a similar approach with our expenses. And we want to know what is cash paid for salary. So we have salary expense of 30,000. Try to get it all in the picture there. And we have to add the change in salaries payable. Beginning of year was 3,000, end of year 2,000. So the company paid down $1,000. So cash paid is 30,000 plus the 1,000, which equals 31,000. Okay. Any questions on numbers 1 or 2? Try to get them a little more into the picture for you. All right. Nobody has any questions? All right. So those questions, by kind of looking at the changes in the account, take the indirect approach. And the indirect approach is what GAAP says you can use. They also say you can use the direct approach. Most companies choose the indirect approach because it kind of keeps their competitors from knowing exactly what's going on. It's not that they're trying to hide information, but they're not putting information out there that is too easily available for their competitors. You can still get the information from either the direct or indirect, but it's not as easily accessible. So here's a couple notes about how the indirect method works. So we didn't do either method, but we kind of used, I kind of slowly introduced you to the indirect method. So here's some of the rules and the basic assumptions of indirect method. And I'm going to bump this up in size a little bit again. All right. So the basic assumptions of the indirect cash flow method. So these are kind of the four assumptions. If the current asset increases, the company used cash to pay for the increase. So if your inventory goes up, then the assumption is I increase that by paying cash for it. Now, we know that there may be accounts payable for that as well. So there's kind of four rules in here, and the liabilities are kind of a swap. So if the liability increases, the company was able to hold on to their cash. So essentially, it's taking kind of a simplified approach in that we're just looking at the balance sheet and making an assessment on whether or not the company used or didn't have to use cash. Whereas with the direct method, it just tells you, this is what we collected from customers. This is what we paid out to suppliers. And that's very different than the indirect method. Okay. So looking at those rules now, we have Avatar Company. And this is a little different because they have unearned revenue instead of accounts receivable. And it's because it always collects cash in advance from its customers. So it's a nice thing to be able to do, right? You don't have to do the job until you get paid for it. You're not sending a product out or doing a service until you get paid for it. So you don't have any accounts receivable. It eliminates bad debt. So how do we approach this? So using our rules, let's see if you can attempt to get the answer to number 3. Type your answer in the chat. Good job, Olga. Seeing the answers start to come through. Give you guys another minute. Good, Nick. Check your numbers, Robert. I'm not sure I see that as an option. Okay, so now most of you put in your answers and most were incorrect. And I think they were focusing on the way that I looked at the last one. So unearned revenue is what type of account? So type in what type of account unearned revenue is. Okay, good. Good. Most people recognize that it's a liability, right? It's money that somebody has given you that obligates you to provide them with something in the future. So it's usually a current liability. Occasionally, it's a long-term liability if you're building a big project. But for the most part, unearned revenue is a current liability. You're going to have to provide them something in the next month, in the next year to cover what they paid. And sometimes, I say it's a long term on these subscription services. So it could be split in terms of its portion. So if it's a current liability, which it is in this case, what happened to the balance and which number applies from our set of rules? Good job, Drew. Good job, Adam. Good. 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 Okay. So let's walk through it. So it always collects cash from its customers in advance. So we have sales equals 80,000, and that's our starting point. Now we have unearned revenue is a liability, and it had a balance of 9,000. And 5,000 end of year. So we apply rule number 4. The balance decreased 4,000. So we apply rule number 4 and deduct that from the sales figure. So we have 80,000 minus 4,000 equals 76,000. So our answer is D. The assumption here is Avatar collected 4,000 less because the balance in unearned revenue decreased. Now, one of the things that I've been talking to you about is the account equation. Beginning balance plus additions minus deductions equal ending balance. So what I'd like you to try is to set this equation up for the unearned or for the cash collected. So set that equation up for me and type it in chat. So not the change from beginning to end. I want beginning balance plus the additions minus the deductions equals the ending balance. You got it kind of inside out there, Natalie. So what increases unearned revenue? Okay, so the answers I'm getting, they're kind of struggling with this. So let's think about it. So answer this, what increases unearned revenue? Okay, I got one answer. Should be seeing a few more here. If you guys know unearned revenue is a liability, how is that liability created? You owe something, but why? Why do you owe something? What happened that caused you to owe something? You guys are being kind of quiet on this part. Excellent, Madison. So somebody gave us cash, right? So we have beginning balance. It's not a loan. Here, it collects cash, you see, from its customers in advance. So whatever you want to call them, deposits minus what was earned equals your ending balance in unearned revenue. So now, okay, now use that equation to put your numbers into that context. Excellent. Got one answer right off the bat. That was good. Waiting for a few more answers here. So what we were trying to find is cash collected. So we'll call that, oops, sorry, I hit the page down button. Deposits. And so our beginning balance, 9,000. Plus, at the time we didn't know the deposits, so we're trying to figure it out, minus what was earned. We know that what was earned was the sales revenue, equals our ending balance of 5,000. So now we just have to solve it algebraically, right? So we have deposits equal, or excuse me, minus 71,000 equals 5,000, right? We combine the 9,000, excuse me, the 9,000 and the 80,000. Then we add 71,000 to both sides. And we get deposits equal 76,000. So there's two ways to do this, and knowing how the account works is one way that you can do it as well. So that would be 9,000 plus 76,000 minus 80,000 equals 5,000. Any questions? All right, if there's no questions, everyone is free to go. And I will see you on Wednesday.